All right, so part two of a Wellesley Income Fund barbell approach that we're trying, barbell investing approach for retirement. This is going to be interesting. So last time we did retiring at the best possible time, which is basically 1983 or the end of 1982 going into 1983. This time we're going to switch around a little bit. We're going to have you retire at the beginning of 2008, so you're taking on the chin, and by far and away that's Wellesley's Income Fund worst year. So let's dive into this so we don't look like we're being Pollyannish here and giving us returns that we're not expecting going forward, because we're not going to get the 1983 returns going forward. Remember, the 30-year Treasury at that point was paying 15 and a quarter, guaranteed for 30 years. You're not going to see that anytime soon, if ever. So same premise. We got a $125,000 portfolio. We're dumping 100 in the Wellesley, dumping 25 in cash. And the cash I have growing at 2% a year, which is undershooting what it really would have been back then. But I just like it because theoretical going forward for sure. And then we're having real returns in the Wellesley Fund going back to 1983. So again, we're just kind of re-engineering the returns and starting with 2008 to look at a sequence of return risk if we were retired in the down market. All right. So we got $100,000. The first year, Wellesley was down 9.84. So at the end of the year, we're down to $90,000. We're taking 6% a year, and we're adjusting that with a 3% each year inflation. So at the end of 2008, we need $6,000. Well, we're not going to take it from the Wellesley Fund because the fund was in the red. We're going to take it from cash instead. So our $25,000, well, at the end of 2008, the first year, we pulled the $6,000 out, and it grew at 2%, so up to $19,380. And then you can see the next few years, the Wellesley was up, so we ended the year at $90,160. 2007, the following year, grew at 5.61, so it gave us $95,217. We needed $6,180 from the portfolio, which we took from the portfolio, which gave us an ending balance of $89,000. Our cash account grew at 2%, so we're back up to $19,000, and so on. So at the end of 2000, again, we're starting at 2008, so it's not sequential like we're used to. It's 2008 is the first year, 2007 and so on. So at the end of 2000, we are up 16%. So we're up back. We started the year at 87,000. The market was up 16.17%. So the Wellesley Income Fund was now back in the six figures at 101. We took 7,601 a year, which left us 93,788 on top of the 22,000 that we needed in cash. So we weren't quite back to where we started from, about 125, but we're about 10,000 short of that. And don't forget, we've been taking 6% with inflation each year. So 1999, we're down 4% because the Fed's Greenspan was raising interest rates. So our Wellesley Income Fund fell from 93,788 to 89,905. We're not touching the money that we need. This year we need 7,829, but we're going to take it not from the portfolio, but we're going to take it from cash. So now this is where something you're going to have to make a determination. So what happened is after we took it from cash, that left us short. We have $15,000 of cash left, and that left us short of having 2 years of income in the cash account. So what I did the following year is I took $20,000 from the Wellesley portfolio. I added it to the cash, and thankfully the Wellesley portfolio is up. So we started the year at 89,905. It was up 11%. So we ended the year at 100,550. So not only did I take the 8063 out of the Wellesley, but I also took 20,000 in cash. So we're down $28,000 total because 8,000 spend. But 20,000 go on the cash account. I hope that makes sense. There's really no rhyme or reason for the 20,000. I probably could have done less, but I just like the idea of having a little bit more cash when the market was up to compensate. Again, that's not as efficient as what a computer model would show you, but I like it. I like having $30,000 in there, and we had breached the 100,000 like we started with. So I was a fan of that. So we got many years of cash in case we do have a calamity coming up for sure. But either way, that's what happened. So we pulled the 20,000 out. Why did we do it again? Because at the end of 1999, we were just short of having over 2 years of living expenses in cash. And I always want to have at least 2 years. All right, so let's fast forward to 1994. We had another down year. So at this point, the market gave us we had broke 100,000 again a couple times, but because we're taking the 6% adjusted for inflation from the portfolio, we never ended the year at 100,000. So in 1995, we ended the year at 91,334, but we fell 4.44%. So we ended at 87,279. But we're not taking that 9,000 we need from the portfolio. Instead, we're taking it from the cash account. So the cash was reduced from 37,820 to 29,501. All right, so we keep going down. Now in 1990, we have 3.76 negative. That was the beginning of the Iraq War. So we ended the year at 98,225 the year before. The markets fell 3.76. So we ended the year at 94,532. We need $10,000 of cash. We did not take it from this portfolio because we are down. We're in the red. So we took it instead from the cash portfolio, and that left us just above 2 years of cash. So we're sitting right there like, I'm going to leave it be. We're just above 2 years of cash at 21,718. So I'm not touching that money because we're just above 2 years of cash. Let's see what we got here. Then in 1989, then we go back to 1987. We're down 1.92%, so the portfolio is above 100,000 again, so that's all good. We need 11,162 this year, but because we were down, we did not take it from the portfolio. We took it from the cash account. And here, actually, I forgot to take out the additional amount from the portfolio. But either way, you can see, the portfolio. So right now, we're sitting at 11,886. I might want to pause that real quick to take that cash out. I didn't actually take the cash out. So hold on just a second. I haven't added the cash because we weren't 2 years above. No, we're right there. So all right, hold on just a sec. All right, so what I did here is I said, okay, at the end of 1987, when we're down 1.92%, our cash portfolio dropped below the 2 years of cash account. What I did is I added $25,000. So the following year, the market again cooperated, and that's happened routinely with bonds. If you look historically, when a bond gets killed in 1 year, the next year it cooperates nicely. I cannot guarantee that's going to happen again. The Wellesley consists predominantly of bonds, so if that keeps going, and I have no clue. But generally speaking, well, not generally speaking, every time bond markets they get nailed 1 year, they're going up pretty good the following. And you can't gamble on that, but just that's what happened. It's in the past, so it's kind of interesting actually if you look at it like that. So what happened? So we ended the year at 105. We did not take the money from the portfolio. We took it from the cash account. So the cash was down to 11,001, basically $12,000, which essentially is just a little bit before what we need for 2 years for 1 year of living expense. The following year is up 18.34, the Wellesley fund. So it went from 105,030 up 18.34% to 124,293. And we took the 11,497 we need from the portfolio from the Wellesley fund. But we also want $25,000 to put in the cash account. So at the end of the day, we started the year at 124. We took the 11,497 to live on, and we took $25,000 to replenish back into the cash account. So we're sitting on 87,796 in the Wellesley plus 37,000 in cash. Hope that makes sense. And then we got a couple nice years back to back to back to back. Look at that. 4 years were fantastic. Now, so you can see, I had 2018 because I wanted to end the series with the great years being on the back. So 2014, 13, 12, 11, 10. So you see what I'm saying? I mean, literally, it's just, I don't want to say it's random, but I said I want the best years to be at the end of the scenario just to see if we end up running out of money. Because we did run out of money, which we're pretty doggone, we're pretty doggone close. These good years aren't going to do us any good. Does that make sense? So what happens now? So now we go to, we're 2012, we're up 10%. Oh, let me just start here. All right, so here, all right, so we got 8%. The markets are up. We ended the year at 71,209 after we had that addition to cash. The markets are up 8%, but only put us up to 76,963. We need $13,000. We take it from the portfolio. Now we're down to 63,000, which is less than our cash account. And even though we made 28% in the following year, we went from 63,231 But this is where it really hammers you. Even though we're down that significant amount of money, or 1.28%, excuse me, not 20%, 1.28. We went from 63,000 to 64,000, but we needed 14,000 of cash, so we took it from the portfolio because the portfolio was in the black, which put us down to 49%, 49,905. Next year, the market was up 8%. We grew to 53,933, but we need 14,564. I mean, so we're just diving into the principal now. Now we're down to 39,369. The following year, the market was up 9.19. The 39,000 grew to 43,000, but we need 15,000 of cash. So now we're down to $27,000. And you can see where this is going until 2011. 10 and a 9%. We're up. We only had 16,000 in the portfolio, but we needed 15,000 from it, which left us roughly $1,000. And then, of course, the following year, even though we had 10 and 11 and 16% respectively, we didn't have enough money to cover that, to cover the cash account. So this is a sequence of return risk. If you just looked at the average of these returns, you're like, wow, that's good. Well, it's not good because we have no cash, because the accounts were being obliterated by huge withdrawals relative to what the account balance was. Now we still have, 72,000, 74,000 in cash. So the cash is still sitting there and looking nicely. So obviously, if you're ever to get to the point where the cash is providing as a higher balance than the investment account, well, you start pulling from the cash without question. Let's not be stupid here. But I want to show you that the facts are, even with those returns, the same average returns, the Wellesley ran out of money. Now, our cash account did not. So after 35 years of living at, let's sum these guys up, and we pulled out, I mean, a lot of money. Oops, let's sum these guys up. I mean, we pulled out, how much did we pull out of these accounts? $380,000. We started with 100. We pulled out 380, and we still got $74,000. I mean, that's not too shabby, man. But if we look at that, and I don't want to say it's a worst case scenario, I'm saying it's a bad case. But if we look at the other scenario, we had 1.127 million left over in the investment account and 21,000 in the cash account. So which one is better? We pulled the same amount of money in each, but $380,000 or $70,000. But just again, it's just timing. Either way, we had 35 years of pulling 6% a year out, adjusted for inflation. 35 years. From 1983 to 2018. That's 35 years. And the Wellesley, not a stock portfolio, heavy portfolio, the Wellesley freaking smoked it. Now, we're going to run these scenarios with other portfolios, but if that doesn't get you fired up as a alternative to what I was showing you with a 3-year CD approach, that gets me pretty fired up. So stay tuned. I got a lot more to come. I love these scenarios because my man Clint was talking about this, and I was like, man, let's look into it. And he's going to run even better algorithms. I think he emailed me earlier today saying he was looking at like 7%. I mean, I don't know, but I'm just like, this is 6. And I just proved it to you. It worked great. Great. Yeah, Wellesley ran out of money in the last 2 years. Again, don't be stupid. Don't say, I got 916, I can take it. I don't know. Again, and I have no rhyme or reason to say if the Wellesley has less than the cash, I'm just using that as an example. I haven't done any science on how much you should keep in cash. I just like having at least 2 years of living expense in there. So, hope you like this. I'd love to hear your comments. So, smash, like, share, and comment below. We'll see you next time.